Okay, we just finished talking about several of these transactions, and in the general ledger right here, this would be a T account version of the general ledger, showing the balance of each account plus all the transaction in each account. So to see the equation working out, you'd have to see both sides. In this case, you see cash, a $30,000 debit, and you see common stock, a $30,000 credit. That's number one. Number two was a $2,500 credit to cash and a $2,500 debit to to supplies. Number three was a credit to cash and a debit to equipment. Number four was a debit to supplies and a credit to accounts payable, same amount. So the journal shows you the equation working out. The balance, the general ledger shows you the balance of each account, and you can use those balances to do things. This little section right here, this little thing right here is not a bad thing just to copy and paste somewhere. It's just the normal balance. Assets have a normal debit balance, and the increase is a debit. So whatever the increase side is, that's the normal balance. So assets increase by debits, decrease by credits. Liabilities, the opposite, increase by credits, but decrease by debits. Common stock, increase by credits, decrease by debits. Revenues, increase by credits, decrease by debits. But dividends and expenses, even though they're on the equity side, are increased by debits, decreased by credits. It really should just kind of click pretty soon. Okay, we added them all up, and if you add the balances on the asset side and the liabilities and equity, that's your they balance, 42,395. That's what this is here. This section here is the income statement. The income statement only includes revenues and expenses. That's all the accounts that are on there. And if you notice, that would only be from the 400 account numbers up through whatever the last number is of your expenses. And the 300s would be dividends, common stock, retained earnings. The 200s would be liabilities, and the 100s would be cash. So the income statement is only revenues, the 400 section of account numbers, and the expenses, anything above 400. Add up the revenues, subtract the expenses from it, and that gets you your income statement. This is a good little video to watch and a little practice to do. Okay, the trial balance. We just list the accounts, the balances of each account as a debit or a credit in the correct column, and add them up to make sure that our balances work. That's the trial balance. I like to list every account we're going to have, and that's going to be more critical in Chapter 3, but in this case we just list all the accounts that we've got there. Even an account with a zero balance should be on the trial balance, in my opinion. List each account and title. This is the way you do it. From the ledger in the trial balance, compute the total of debit balance and the total of credit balances, and prove that debit balances equal total credit balances. Just add them up. Simple, simple. Like it says here, the equality of those two totals does not mean that no errors were made. It just means that you have a chance of having it right. If they don't balance, that's the first thing. If they don't balance, you've made an error, an error that an accountant shouldn't make. But if there could be errors in there anyway, it's when you start searching for errors, that's a huge skill that accountants need to have. So, I worked as a CFO of a construction company for 20 years, and most of the time I didn't do data entry. It was a small office, so sometimes I would jump in there and have to enter payroll or accounts payable or something. But generally, I was overseeing the books. I was formulating, analyzing, and creating the journal entries for other people to enter. And I was also, running reports and making sure there weren't any errors. And if there were errors, starting to find them. We weren't ever out of balance, but there would be errors, something to get in the wrong account or something like that. One way they mentioned several good ideas here. An efficient way to search for an error is to do everything in reverse order, from journalizing, posting, and trial balance. So you first verify that the trial balance totals add up correctly and all that stuff. If that doesn't find the error, then the step 2 is go to the account balances in the ledger and see that they are carried over to the trial balance correctly. For example, here's your trial balance up here. The general ledger is right here. Oh boy, howdy! Let me go faster. Here's the general ledger, and you would just check each balance. Here's the cash, and here is let's see, supplies, 97.20, and you go over to the trial balance and make sure that the accounts are in the right column and that they are the right amount. That's what it's saying there, to make sure they're carried correctly over. Step 3 is to see whether a debit or a credit balance is in the wrong place, and I just mentioned that. A clue to this, it says, is when the difference between the total debits and the total credits is equal to twice the amount of the incorrect balance. So if you have in this case, if we had a difference of $610, I would look and say, utilities expense is half that. I wonder if I got it in the wrong place. Well, this is correct, but if the 305 were over on the right side and the credit side, the difference would be $610. And then to recompute each account balance is like over here. Let me go back up here a little quicker. Just do the addition in each account. Add up this side, and make sure that you've got the right balance. And finally, go to the journal entry. If that doesn't find it, go back to the journal entry and make sure each journal entry is correct and then posted correctly to the ledger. And somewhere in that group of steps there, you will find the answer to your problem. Just a hint, this is an interesting thing that most people know pretty quickly, is that take your error. If you have an error here, find out how much the error is, and just keep that going. You may find one error, and the difference changes, but it doesn't balance. It's not right yet, so you just have to keep looking until you find all of them. But always write down your difference, the difference between your balances or whatever you're looking for, and just keep changing that as time goes on. Keep updating it as you're finding errors. Let's see here. My phone is doing things. The other thing is, if you check your difference, if you subtract these two numbers and they're off, they're not the same, you subtract them. If the answer is divisible by 9, that is often an indication that you have transposed a number. For example, if you put in, instead of 4275, if you've put 2475, the difference is going to be divisible by 9. If you transpose those numbers, 4275 minus 2475 is a difference of $1,800. Well, 1,800 is divisible evenly by 9, no remainder. So anytime you see something that's an error that's divisible by 9, think of a transposed number somewhere. Preparing a trial balance, we did that. Searching for errors. Financial statements. The first thing we do is the income statement. That's the first thing we do. Statement of retained earnings is the second thing we do. And then we do the balance sheet, the ending balance sheet. So we have the beginning balance sheet with just assets, liabilities, and equity. We have the income for the current year, the retained earnings, statement of cash flows, and then the ending balance sheet. The statement of cash flows is the last one, so it goes in this order: income statement, retained earnings, balance sheet, cash flows. That's the order of this financial statement preparation. So on the income statement, it's for a period of time, not for one. It's got to be for a time has to pass for these transactions to occur. So we put in our revenues. You see how they got them organized here. List the revenues, total. List the expenses, total. Net income. Take your revenues, subtract expenses, you got your net income. Now we go to the statement of retained earnings. We start with our beginning retained earnings. In this case, the company started on December the 1st, so there was no retained earnings. Add our net income, subtract any dividends, and come up with our ending retained earnings. And then we take our ending retained earnings and we put it into our balance sheet. We have our assets, we have our liabilities, we have common stock, and retained earnings. That retained earnings includes all these accounts, all the revenue accounts, all the expense accounts, and the dividend account. All those account balances are now totaled up into retained earnings. They're just wadded up right in there. So you can take all those numbers, all of these numbers, including dividends, and that becomes my retained earnings at the end of the year, and now my balance sheet will balance. A balance sheet, let me go say this again. An income statement only has revenues and expenses. Once we're done with them, we don't see them anymore. We take that net income, which is the difference between revenues and expenses, and we put it on the statement of retained earnings. We subtract from it the dividends and come up with our ending retained earnings. And we don't see dividends again. They're gone. Retained earnings is permanent. And so we call revenues and expenses and dividends, we call them nominal or temporary accounts. Assets, liabilities, and then equity, the common stock, retained earnings are all permanent accounts. But revenues, expenses, and dividends are temporary or nominal accounts, and they get closed. That means the balance is returned to zero at the end of every accounting period. So the balance sheet is never going to have an expense on it. It's never going to have a revenue on it, and it's never going to have a dividend. The revenues and expenses go in the income statement. Net income and dividends go in the statement of retained earnings, and then the balance sheet takes retained earnings, assets, and liabilities, and equity. There we go. And the very last thing is a ratio that investors and creditors and other people look at. And we'll see a couple of these in every chapter. In this case, it's the debt ratio. Simple. Divide total liabilities by total assets. And we can figure that out on the balance sheet over here. Our total, where are we at? Balance sheet. Total assets is $42,395. Total liabilities is $9,200. So we would divide total liabilities by total assets to get a debt ratio. For this guy, the debt ratio is 21.7%. So that means they're let's see how to say this. You can only buy assets either with debt or with equity. And so in this case, it means that their assets are furnished 21.7% of them by debt, the rest of it by equity. Total liabilities by total assets. If you look at Costco and Walmart, total liabilities this year, total assets this year, debt ratio is 0.6. 0.68 last year, 2 years ago, 0.7. And you can compare two different accounts. Take Costco and Sam's Club or something and see what their different debt ratios are. The higher the debt ratio is, the more risk the company might face if the economy goes south. As long as things are going well, you can carry some debt. But when sales go down and things, you can't sell your stuff, all of a sudden you still have to service that debt. You still have to pay the interest on it, even though you're not recording the sales or recognizing the sales that you used to have. All right, that's the end of chapter 2. That's 3 videos talking about this. I would pay tons of attention to how to make journal entries and how to post them. And we are going to have to get serious about that in class and even go a little further than the book has in order to do the practice set with Perdisco. So I will see you guys Thursday, and we'll get to work on making journal entries and posting them to the ledger.